computer. All right. All right. Hey, everybody. My name is Justin Bogard. My company's Bright Path Notes, and this is the Real Estate Note Investing Be the Bank Meetup. Woohoo! I got my co-host for today is none other than Miss Czarina Harris, and I got a slide dedicated to you coming up in just a minute. So if you need my contact information, I used to put my phone number up there, Czarina, and I realized that wasn't a good idea because I'm not answering my phone all the time. So I decided I probably ought to just put my email address in there, at least for someone to get a hold of me. So anyways, it's justin@brightpathnotes.com. And come on, slide presentation. By the way, I am sharing a slide, Czarina, all right?
No, you're good. Yeah.
I am. Okay. All right. Big disclaimer here. I'm not an attorney. I'm not a tax consultant. I'm not a financial advisor. I'm a note investor. Just got to throw that out there so you guys know. I just give examples of my experiences. And my guest like today, Czarina Harris, she'll give examples of her experience. So we're not trying to give any advice here. We're just showing you what we know, what we've seen, and what we've experienced. And that's what we want you guys to learn from. This meetup wouldn't be able to happen if it wasn't for a couple of sponsors. So my company, Bright Path Notes, our slogan is, Czarina, I don't know if I told you this, but we've got the deal flow to make your cash flow.
Cash flow.
That's our slogan. So we have a page dedicated to some notes that we sell from our inventory from time to time, and other people that want to sell their notes. So we have a page, a note deals page on our Bright Path Notes website. So come check it out. We do have access to many other loans that we look at on a regular basis. So if you're looking for other deals, we're your guy. If you're looking for non-performing, I don't know if now is a good time.
That was a nice little pause.
But I'm not telling you not to do non-performing. I'm just saying performing is where it's at. Okay. Real estate note education. Real estate education. I'm sorry, not just note education. We have a local community here, a RIA community called CIRIA, Central Indiana Real Estate Investors Association. Some of you are a part of that on this call today, and some of you are not. Anyways, if you are interested in being a part of our RIA, here is the executive director's information, and you can sign up to be a part of our RIA. We have over 800 members in our RIA group. It's very active. We got a lot of people that do a variety of things. There's some great wholesalers, landlord people, fix and flippers, and attorneys and title companies that are all connected to our real estate group, and they're really phenomenal people. Being in the Midwest here in Indiana is obviously a hotbed for real estate investing right now, so it's a really good network to be a part of. Our note group is a part of a subgroup of the CIRIA. That's why some of the folks on today's call are members of the CIRIA. When I do have live events because of COVID, Czarina, we typically go to this workshop or this workspace that is called Launch Fishers. It's just it's kind of just a big shared workspace. It's got a big building. It's got a theater room that I host the meetup in. Obviously, due to COVID, I'm not trying to risk anything, and I don't want people out even attempting to try and get sick or infected by this unworthy virus. And so anyways, the person you would contact is Libby Hales if you were interested in being at a shared workspace here in Fishers, Indiana, which is kind of north and east of Indianapolis. If you're local to the area, it's a great place to be a part of. I'm a member there, so when I am going out and about, that's where I kind of land and do my business and my meetings. Our due diligence sponsor is Dickie Baldwin. I don't know, Czarina, if you've ever worked with Dickie or not, but he is an awesome guy. He's got a great due diligence package, if you will. He's got title reports. He does skip tracing. He can do property inspections. He can do BPOs. He pretty much got the full gambit when it comes to doing due diligence. And his slogan is one bag for all of your real estate services, Dickie Baldwin. There's his number and his email. So if you guys are looking for help, or if you need another vendor to use for this stuff, I would highly recommend Dickie Baldwin, and we use him, exclusively for a lot of our stuff. He's very quick, very efficient. For those of you in CIRIA, I got to do this slide for us real quick. Don't forget to follow CIRIA on Facebook, LinkedIn. I almost said Instagram because I had IN up there, and then Instagram is the bottom one. So you guys can read those handles up there. They also have a YouTube channel where they post a lot of stuff as well. They try to do all their subgroups like this one, a recording. So I'm going to record this. I know someone just chimed in about this. I'm recording this right now, and I will release it more likely tomorrow on my YouTube page, Bright Path Notes YouTube page. And then also we're going to post it in the Cyria stuff as well. There's something called PHP credits, and I always forget what this means. And somebody always chimes in and tells me, and I still forget what it means. But anyways, if you're part of Cyria, you would pay attention to this slide here. Okay, there is a URL that you would type in, or take your little smartphone out like this, hold up the camera app, kind of move in on that QR code, and it's going to take you to a website, and you fill out your first name, your last name, your email address, I believe, and then it's going to give you PHP credits towards taking this subgroup. So you get these credits, could have value to you in the future. It could help you with some sort of certificate in the future. Anyways, I'm here to present that to you, and that's what it's all about. Professional housing provider. Thank you, Michelle. I knew somebody on this call would help correct me, and I'll probably forget that for the December meetup. So.
Need a sticky note.
All right. So the second greatest podcast of all time, and I'll tell you who the greatest podcast of all time is the Two Wealth Show. That's me and my co-host, Super E. Czarina, I don't think you've had the pleasure of meeting Super E, but she is.
I have not.
Awesome.
I've heard one of your shows though.
Yeah, she is super awesome. She is a short-term rental guru. She is a national speaker on the stuff. She's a keynote speaker on the stuff. She is phenomenal. She is rocking the world when it comes to short-term, and she knows all of her numbers inside and out. She's an awesome person just to know about in real estate. She's really cool. Her real name is Elizabeth Sickles, but she likes to be called Super E. And with Super E, I host this podcast called The Two Wealth Show. We also record it on video. So we have guests on there that we interview sometimes. Like we just got done interviewing Jeff Jinks, an attorney here locally, and who is really hot against the CDC moratorium, and had a lot of good things to say about that. And so anyways, you can check us on any of the podcast directories. We're on it. We also stream it, like I said, on my YouTube channel and Elizabeth's YouTube channel as well. And then let's see, the number one podcast you should listen to is definitely the Note Inc. podcast. Hands down, not biased or anything.
Appreciate it.
So Czarina Harris is our guest. She's not on camera today because, well, I
have a little brother who walks around shirtless.
But that's okay. You know, you can just put up a virtual background.
That
right?
kind of show.
Anyways, Czarina is typically on camera, but today she's not. That's okay. We can just stare at me, or I can turn my camera off if we get a lot of a negative feedback there. So anyways, you can reach Czarina at info@noteinc.com. Her company is Note Inc. Look up in the podcast directory that you like the most, the Note Inc. podcast. There's 3 seasons out or 2 seasons out right now?
2 seasons and some filler episodes, but season 3 is being outlined. So
yeah, it is a phenomenal podcast. I'm telling you, Czarina put so much effort into this. It is a professionally done podcast with a fictional spy-themed note investing twist to it. It's really, really good. She's got a bunch of voiceovers on it, and it's got a great story to it. And most importantly, you learn things about it. So check that out for sure. All right. Today's agenda, Czarina, what we do is we like to go over the note basics. We're going to have people on this call today that are going to be very familiar with notes. We're going to have people on this call today that are not even familiar with real estate investing in notes, which is perfectly fine. Don't feel like you have to hop off the call. I'm going to explain some things to you. I'm going to give some mortgage industry updates, and it's going to coincide with what you're doing today, Czarina, which is the most lucrative business strategies during COVID. Czarina is much fancier with her presentation slides, so I feel kind of dumb when I have to have my presentations compared to yours because yours looks awesome. So when we transition to Czarina's, you're going to realize, okay, this is how it's really supposed to be done.
I appreciate it.
I always tell her too, when I do a presentation, I was like, don't spend any time on this stuff. Don't spend a lot of time on it. You're going to outdo me. All right. Steve said he only joined to see Czarina today. Sorry.
Oh, thank you.
Bursted your bubble, but that was a very nice compliment.
Thank you.
We all want to hear and see from Czarina all the time. That's why you're on here. So that's what we're getting into. So, man, Czarina and I, we've known each other for probably about four or so years now. You were affiliated with another company that I got training with, and I learned from it. And you were one of the people that helped me learn the note business as well. your specialty, in my opinion, is you're really good with the marketing part of a business. You're extremely good with research as well. I'm kind of a research nerd as well, and you definitely outshine me. So I look to you to figure out where to get stuff from. And fortunately, we go to the similar sources to get information. So you're going to see a little bit of overlap on the audience today of some of the stuff that we have to present. We didn't really collaborate too closely on what we're going to present today, but that's okay. We have a little bit of overlap, and I think you guys will enjoy today's presentation. So it's going to be more focused on information today. You will have plenty of time to ask questions. Please, please, please use the Q&A portion of our Zoom meeting here today. If you want to put something in the chat box, you're more than welcome to. Czarina and I are both panelists here, so we're both going to be reading stuff and laughing, and then also trying to comment and chime on things. It's going to be a pretty good free flow. So those of you that don't know much about real estate, this is the time for you to pay attention, or specifically note investing. We're going to walk you through the note basics, okay? Are you ready, Czarina?
We're ready.
He's ready. All right, ladies and gentlemen. This is what happens. We have a buyer, we have a seller, and we have a house, right? Everyone's probably been through a purchase of real estate personally in their life before and gotten a mortgage, and we're just going to walk you through what that looks like and how us as note investors get involved and, well, make money, right? Because we're in the business to make money. So the seller of a property has a deed. They decide to sell that property to Mrs. Buyer here. So now they're conveying the interest in that property over to the buyer at a closing. Title company we'll assume that, right? We probably should be doing that. And then the buyer typically is not going to have all cash. They're going to have partly cash, like a down payment, and then they're also going to need help funding the rest of the deal, which is where the bank comes in, right? So they create what's called a note in mortgage is the general term. This also can be called, you've heard of land contract. You've also heard contract for deed. You've heard deed of trust, agreement for deeds. There's a lot of name for them, but we'll just generally call this a note in mortgage just for all intents and purposes for today. All right. So this is an important part of the slide, is that the note in mortgage is what the bank creates, right? So the mortgage is what secures that debt for the bank, which is the real estate, which is why that lock and chain came in there. All right, so the bank owns the note or the debt, right? They don't actually own the house. The buyer owns the house because they're on the deed, right? So they're the true owner. They are borrowing money, and there's a lien against their house, which is the mortgage. So now we understand how that works. We're going to fast forward to how the investor comes into this. So remember, the house is owned by the borrower. They are on the deed. The bank owns the mortgage on the property. And we have this investor over here. Now, this investor can be a LLC. It can be an LLP. It can be a trust account. It can be a retirement account like a self-directed IRA or a solo 401k. It could be just an individual wanting to buy this as well. We always prefer you to do it in an entity like an LLC, or if it's a retirement account, a trust, or with a self-directed company. That's just the best way really to do it, but you still can buy it in your personal name. So this is what happens. The money changes hands. So the investor or the investing entity is just purchasing that debt. You notice nothing changed hands with the borrower. They're still on the deed. They still have to make a payment, right? They're not forgiven for making a payment. But instead of paying the bank, they are going to be paying this investor now because the investor owns the paper. So this is in a nutshell how it works. Pretty simple, pretty easy. There's paperwork involved, but this is how it works. For those of you that are unfamiliar with note investing, there's your crash course with note investing. So if you have any questions, go ahead and chime in on the chat box or the Q&A, and I'll definitely answer them throughout the presentation today. But that is my note basics. Are you good, Czarina?
I'm good.
2020 is almost over.
I know.
We got like 6 weeks left.
I wish COVID was over, not 2020. It seems like 2020 got put on pause, and then we just kind of been living in a zombie zone. So
yeah, that term has been used a lot. Zombie housing, zombie mortgages, zombie renters, zombie tenants. It's like,
now I know how zombie apocalypse happened by how this disease spread. I was like, oh, that's how it happens. Okay.
I should have had a zombie slide. That's what I
You
should
should
have.
have. You should have. I should have thought of that. I should do that on the podcast because I have the room for doing that.
Yeah.
Anyway.
Czarina's getting a lot of love on the chat box. I love to see that. I'm glad I invited her on.
Man, some of the coolest people like me, so I'm grateful. Thanks, guys.
You are one cool lady.
Appreciate it.
All right. So I'm going to start off and do some of the stuff that I am researching right now. It's going to, like I said, it's going to coincide with a little bit of what you're going to do as well. And Czarina, you can feel free to chime in at any time. But I had to delete some of my slides because I didn't want to overlap too much of what you're doing. But we both get a lot of information from Black Knight Financial Data. So that's one of the sources that I use, which is one of the sources that you use as well to look up mortgage trends. And so it's
I just want to chime in and put some credit here. I was like the first person at the previous company you know me from to use Black Knight, and then everybody started copying me. So I just want to put that credit out there for myself because it's really good information.
Credit deserved and credit noted. Okay. But that's really where I got my
no, I mean the data's excellent. Yeah, it's excellent.
So I appreciate that. It's great information. They put out a very solid report, and that's what I look at. And the timing wise works out well for this meetup because it always comes out, it seems like right before this meetup. So we have pretty up-to-date information within about 30 days or so. It's pretty accurate. Steve says credit given. Nice. So what I like to do, Czarina, is every month since COVID's been hitting, I'm really trying to monitor what's going on in the mortgage industry and look at these loans because as you know, Czarina, I know we're probably on the same page on this. There's been a lot of misinformation out there and a lot of media going biased towards what could happen or what they feel like is going to happen. So I'm going to throw up a poll real quick, actually, before we get started too far. Where's my polling app? I'm going to launch a poll, and y'all can hopefully that pops up on your screen. I'm not sure what it looks like on your screen when you're an attendee, but there should be a poll that pops up that's talking about, do you think there will be another foreclosure tsunami? I hope I spelled that right, due to COVID-19. And I just want to get a heartbeat on what everyone is thinking right now. It's okay. There's no right or wrong answer. And believe me, Czarina and I don't have a crystal ball, but we have a rear view mirror. And so we
I like that.
Our best to analyze this data and show you what we feel like is going to happen. So we got stuff rolling in. Here we go. We got yeses. We got nos. We go, I don't knows. We've got people in the chat board saying, heck yeah. I like this. This is very active tonight. So I'll leave it open for another minute or so. September overview. I like these stats that come in for Black Knight. So some of these numbers may not make sense to you now because you're going to hear a lot of numbers, but what you do need to pay attention to is the green arrows going up and the red arrows going down. The red arrows going down are actually positive things.
In this case, yeah.
Yeah, in this case, it's all positive. So the change in delinquency rate, that's not what our delinquency rate is. That's just what it's dropping down to based on the previous month. So every time this comes out, like in August, and now we got September's numbers, comparing it to August. So you see just a trend month by month and see how things are working. So there are now like 821,000 mortgage holders that are a single month behind on payments, it's down nearly 20% from the pre-pandemic levels, which is probably around the February, January timeframe, and the lowest on volume records dating back since 2000. So there's just, things are getting better. Looks like we've got a lot of people filled in on the poll. Some will end the poll now. And we got results here. So I'm going to share the results. We got
very
good amount of people that said yes. A few people said no, and a few people that just weren't sure yet. And let's just see how that aligns with how our presentation's going.
Yeah.
So we do have a lot of data to cover today, so I'm trying to go a little bit quick. So another one of my favorite slides is when I see the delinquency rate here for the first lien mortgages. So keep in mind, those of you that haven't been on this meetup before and know what these numbers are really pertaining to, it's taking all of the major mortgages in the business, like the mortgages that you would get from Fannie Mae, Ginnie, Freddie Mac, some of the big banks that create loans. All these loans are in here. Czarina, I think in this, it's around 60 or 70 million loans it probably aggregates in this data.
So Black Knight has a 99% coverage of all mortgages in the United States, and it's about, right now, it's about 51 or 52 million.
Okay. So just, okay, 50 million.
Mm-hmm.
Thank you for that information.
Welcome.
So as you can see, in the worst that it's ever been, I don't know if you see my mouse, but in about 2010 in February or whatnot, it looks like it hit the worst that it's ever went in delinquency. That means anybody that's not made a payment past 30 days, that's, you fall in that delinquency category. So we jumped up in COVID. We got up to around the 7.75%. And then now we're back down to 6.66%. So it's jumping down ever slowly. And normalcy is anywhere from this 3 to 5% window down here. So we're not really too far off. Okay. What I thought was really cool about this data, this slide, is it's comparing COVID-19's peak, which we assume it already peaked, compared to the Great Recession peak. And so this is a lot of data here, but I want to try to focus in, my mouse works here, on kind of this category right here. So you notice that this third column over from the left is the COVID-19 peak, and the fourth column over from the left is the Great Recession peak. So you're looking at these numbers going, okay, the total delinquency looks similar, and the total non-current is quite a bit different. And so what that is, it's the foreclosures. So right now we don't have a lot of foreclosures going on because there is a moratorium, but at the same time, what you guys are going to find out during these slides is that a lot of these forbearances are becoming performing. Okay. So these numbers are just quite interesting. I'm not going to keep them up there because you'll probably get cross-eyed if you look at them too long. So I know I'm starting to get cross-eyed. Mm-hmm. But this is really interesting data. So every month we're seeing this pie chart and we're seeing really positive things going on. So if you notice that this is as of October 20th, 2020. So it's pretty recent. So of all of these that were in forbearance, of these loans that are in forbearance, okay, 36% of them have already expired and became re-performing. So that's a good sign, right? They didn't go through foreclosure. They started re-performing and started paying again. We still got ones that have extended their forbearance, this 38% over here. This little 9% slivers over here, we're having people that are active in forbearance, but also through their original term. So they get thrown in this, this good category, this 9% over here. And this other 8% have paid off their loan. So I don't know if you noticed, guys, but there's a lot of refinances going on, right? Because the rates are, you know what the rate is, Czarina?
I think it's 3.75 or 3.5.
It's pretty low. So a lot of people are refinancing and it's been shooting up property values. I didn't even realize the property values were shooting up so high because I'm only.
You know why that is?
Why?
Because there's $6.5 trillion in tappable equity.
Tappable equity. That's what we talked about last time.
Tappable equity is different from regular equity. Tappable means you can get a refi loan and still have 20% equity.
Isn't that amazing?
So it's really like it's almost like $8 trillion in equity.
That's amazing. So real estate appreciation has saved a lot of these mortgages.
Pretty much.
Could be worse, right? Because 2008 financial crisis was a mortgage meltdown, and that was the opposite of it, right? Real estate values dropped completely, and so mortgages got underwater very quickly. So there's not a high likelihood that a mortgage will be underwater even with a forbearance. So this leads into this slide. So you can kind of see this middle line here is 0, and then below that would be negative, and above that would be positive. So obviously recently, within the 2020, this is probably May where it flattened out and where it dropped and flattened out, and then it's been jumping back up ever since pretty sharply. So this is a general national thing. It may not be specific to your market where you're at right now. I'm trying to go quick through these slides. Usually I take more time and dive a little deeper into it.
You're fine.
But I'm going to start. I think we're getting into your slides now. So you're going to notice these look a little bit different now. This may look professional. This is where this is how a professional does it, okay?
This is how a person who took graphic design in high school does it. That's all. That's it. Okay.
I'm just so embarrassed. I got through mine quickly.
No, you're
forget about them.
So just to give you guys a quick intro, some of you guys have seen some of this material before, but not as truncated as you will see it. So I did a presentation. Maybe some of you guys are familiar with a woman named Tracy Rui, and she's been in the note industry for a very long time, at least since the mid 90s. Could be before then, but I'm gonna leave that alone. Anyway, she has a online expo that she does called the Wise Women's Expo. And it's not just for women only, but it's just women panelists and female investors. And she asked me to be a part of it. And I said, sure. And she said, well, you have, 45 to 50 minutes to, present whatever you want. And I said, well, what do you want me to say? And she said, just whatever you want. That's the wrong thing to tell me. Like you really should. So I actually didn't have an idea of what I was going to present for the first month and a half that she asked me to do it. And it wasn't until she actually published like who was speaking that I even got an idea. And the only thing that I was thinking was, please don't let anybody else have my presentation. Because there were some other note investors, amongst other things. There were like some real estate professionals and people for like mental health and stuff like that there as well. But I was praying like, please don't let anybody have my presentation. And I said, I could probably do something on COVID because I think I have a different perspective about how I look at the note industry than other people. And part of that comes from just being around for a while. The other part of that comes from being a nerd. And so I just combine the two. And so what you're going to get is a very, very, very truncated version of a presentation that really spans about an hour and a half to an hour and 45 minutes. So I just took some of the most important parts of the presentation to kind of put here. And the presentation is called Market Shift. So you're going to see some slides pulling from that information. And then I've also added some other stuff on the back end because I promised you in an email that you would get to see behind the scenes a little bit of stuff. And I always keep my promises. Right. So that being said, I think we're good. Okay. So fair warning. I use a lot of like pretty fonts and they're not showing up. So
I'm sorry.
I don't use, no, it's fine. I don't know why PowerPoint does that to me, but anyway, next slide. So, and I use a lot of animations. So this is kind of how my brain works. I do a timeline, click. Actually, I do a lot of animations, Justin. Can I get control?
You can.
Okay.
You can get control. Go ahead and pull up the slide on your side. You still have the slide presentation on your side?
Yeah, I do, yeah.
Yeah, go ahead and slide that up. I'll stop sharing my screen.
Gotcha. So let's do.
I'm going to answer some questions in the background.
Cool. So I'll switch over. Share screen. There we go. And here we go. All right. Here we go. All right. So this is red and blue cycles. As you can see, the font has dramatically changed. So I kind of view things in a timeline. So from 1980 to 1985 sort of is a period of deregulation. And then from 1986 to 1995, you have what's called the savings and loan crisis. By the way, some of the long-standing veterans in the business were around during this era. Then after that, you have a period from 96 to 2007 that was just kind of pretty normal in terms of real estate and things like that. Houses were appreciating, nothing too dramatic on the horizon. And then you have from 2008 to I'm calling 2016, which is the housing crash. And then you have today. And how I view all of these is I call them blue cycles. And that's because during that particular period, the emphasis or the most profits were in performing loans during that period. And then I have a red cycle where most of the profits and most of the opportunity that you'll see is in non-performing or defaulted loans during that time period. And so I just go ahead and I color in and you can kind of see how we go from one to the other. Now, this is not red and blue for anything political, but a lot of this is around politics.
Does it coincide with the president, what their
It kind of does, actually, a little bit, but it's in the opposite way. So I'm not going to get into politics, but anyway, the blues are caused by reds and the reds are caused by blues. So whatever. So anyway, let me just go back to this. This is how I look at the overall industry. Now, someone who's new to the industry probably hasn't heard it or seen it this way, but this is just when you have too much time on your hands to study notes, you just start to do these kinds of things. So this is where note nerds come in. So I call them like shifts when it goes from red to blue and red to blue. And so you'll see the first one there on the left, that blue cycle, right, where performing loans are really the way to go in terms of profits and opportunity. I just call that deregulation because that was the early 80s. And many of you are familiar with Ronald Reagan. And then what happened after that is the savings and loan crisis. So then you go into a red cycle. After that, again, you have a blue cycle, which is actually the last sort of housing thing that we had, which was deregulation and very easy lending. If you're breathing, you can get a loan. Everybody's familiar with the 2008 stuff. And then we have the housing crash again. So it's another red market and so on and so forth. And so this is how my brain sort of looks at these types of things. Now, mind you, I'm truncating a lot of stuff. The deregulation that happened in the early 1980s caused a very interesting result. So this is a chart, and this only goes from 1988 until 2018. So it's only a 20-year span. But this is the number of banks that we actually have in the industry, like just brands, different banking brands. And as you can see, it's on a downward trend. The reason I'm showing this is because I want you to understand sort of the macro and the micro. This is a macro, meaning COVID is not going to magically add another 10,000 banks, right, into our nation. It's pretty much going to stay on this same trend no matter what is happening in the world. So COVID is not going to affect the fact that the more time goes on, the less and less banks that we have. Part of this, which I did not include in this slide, is you can actually pinpoint different regulation, meaning like different laws that are passed to certain things that happen in the market. And I won't go into that because it's just too much. But part of the reason why we have the like super banks that we have now, which is like Wells Fargo and Chase and U.S. Bank and B of A, is because of a law that was passed in '99. Coincidentally, this is whatever, but it was passed by Joe Biden, and it basically took down the wall between commercial and investment banking. There used to be a wall between that where commercial banks could not merge with an investment bank. That was then deregulated in '99, and that's where you saw all these mergers, right? So Wachovia merged with Wells Fargo, and then Washington Mutual merged with Chase Bank, and you just kind of see like all these banks dying and like these super banks becoming a part of our new banking system. What that does, though, guys, is investment banks are only concerned about one thing. They're concerned about profits. And mortgage origination specifically is not the most profitable model. Actually, the most profitable model for an investment bank is to eat smaller banks. Hence why the number, or why this slide looks like this. So they would much rather take over a smaller bank that's failing than to try to make profits off of originating mortgages. How you see that is with this slide here. So the top 10 mortgage lenders of 2019. Now, don't ask me why they released 2019 data in July of 2020. I don't know. Maybe it takes them 6 months to get the information together.
I believe it.
But when I tell you, what's that?
I believe it.
Yeah. This is the most accurate data. This is from the CFPB, which is the Consumer Finance Protection Bureau. And they regulate everything in finance now, ever since the Dodd-Frank Act came out. So we're talking 6 years, 2014. And they put together who are the top, this is actually a list of 25, but I just put top 10 for the sake of the slide. Who are the top 10 mortgage lenders? If you looked at the one from 2018 to now, you would see much, much change. Number one is Quicken Loans for 2019. 2018, that was Wells Fargo. Wells Fargo is now in number 3. United Shore Financial Service, I never even heard of them. Now, you may be in a part of the country where you've heard of them. I've never heard of them.
I haven't either.
Yet they're the number 2 lender in the United States. Then you have Wells Fargo Bank, JP Morgan Chase. What's unique about them is you can scroll over and look at originations, but look at the purchases. In the case of Wells Fargo, at least, they actually purchased more mortgages than they originated. So they're getting more and more out of the business of originating loans and more into the business of buying notes. And then you can go all the way down with the rest of these. 6 out of 10 of these people in the top 10 are not even banks. They're independent mortgage companies or independent lenders. Why is that information relevant to like COVID and all this stuff? Because this is giving you, COVID or not, this is giving you what is happening in our industry on a very high level that is going to affect you as a note investor. Okay? Smaller companies are going to be making these loans and bigger companies are going to be buying them. When they buy them, do you think they're buying them at par or a premium or a discount? I don't know.
Good question.
Right? But if it's even a slight discount, what these larger banks are going to do is set a precedent that mortgages are bought on a discount. That makes your life so much more easier, right? You don't have to convince people that you're going to take a discount when I buy your note or when I sell this or whatever. It becomes the norm. Now, the returns are going to be a little bit different from what we do as note investors, but this is just an important slide to kind of show what's happening. And the number 10, which is US Bank down there at the bottom, these are in thousands. So they produced 94,000 original loans and then they bought 96. So again, another bank that actually purchased more loans than they originated. Okay.
This is really interesting data. I'm glad you brought this up.
You're welcome. Note nerds unite. All right. So
like that.
So the overall trend again is, well, I'll get to that. The other one, the overall trend is less and less banks, more super banks, and they're going to be buying more loans in the future than they are originating. Therefore, smaller mortgage companies are going to be popping up to do originations, to sell them specifically to banks. They're not going to hold these. Some of them are just going to be companies that just originate loans and sell them off. We saw a lot of that in 2008, and then they went belly under, but it's happening again. So a little bit of that cycle is going to be moving forward, growing. I erased all my slides about this stuff, but I'm going to give you just a quick blurb. These are market voids. So whenever there's a void in the market, that's where your opportunity to make money is going to come in. And you can go all the way back to 1930s when they started this whole sort of mortgage trend in our industry to prove that. So I erased all the information about that, but just really quickly, there's 3 main voids in the market. The first one is actually a racial void. The second one is a collateral void. So I kind of used the mobile home. And now the third one, which is a more recent void, is a value-based void. So banks are less likely, not that it's impossible, but they're less likely to finance anything under $100,000.
Right.
That's not going away. And so you have these opportunities already here, regardless of COVID, that you can kind of look into and see how you can make money in these voids. Less mortgage funding by traditional banks, greater disparities in these current market voids. That's what we're looking at. So some shifts are shocking and some are subtle. This one is obviously shocking, right? When we had this housing crash, why real estate just bottomed out, right? So people are very familiar with this, and because they think, and because we're almost conditioned to only understand a major market shift when something bad happens, when something good happens, we kind of miss it. And that's where this one comes in. So in 2016 was actually a market shift from a red market to a blue market. And I'm going to prove it to you in the next few slides.
Excellent.
Yeah. Also noted, because this was part of a greater kind of lesson, 90% of note brokers went out of business during the 2008 housing crash, mainly because the note brokers who were, from the 90s and stuff like that, they sold 90% of all their loans to the same company called Bayview. And Bayview, get this is kind of how crazy it is, but Bayview was selling seller financed, back of a napkin mortgages as mortgage-backed securities on Wall Street. And I'm pretty sure they got A+ ratings or something. That tells you how crazy it was. Wow. How they were packaging stuff. So when Wall Street went out and said, hey, we're not doing any more mortgage-backed securities, Bayview said, well, we're not buying any more seller financing. And then the broker said, well, who are we going to sell to? They said, tough luck. Right. And that's why they went out of business. Okay. The people who survived that then decided, for one reason or another, circumstance or whatever, nothing against it, but a lot of the people whose brokering business went out of business during the shift in the housing market are now teachers in the market, and they have a very long history of kind of looking at the note business. So that's just kind of like, where do these people come from? How long they've been in business? Like, how could they be in business from the 80s and 90s? Because they've survived, through the different shifts. All right. So I promised you I was going to kind of show you why the market shifted and prove to you the market shifted from a red market, meaning most of your profits and your opportunities in non-performing, to a blue market where most of your opportunity and profits are going to come from performing. I want to show you this slide. Fannie Mae. Fannie Mae is the reason it shifted. Well, not the reason, but one of the main people who shifted this thing. Not people. From April 2015 to September 2018, Fannie Mae held 50 loan sale offerings. Now, a little bit of context. Fannie Mae never. Now, Fannie Mae was created when? In the 1930s, right? With the New Deal and, Roosevelt, right? Fannie Mae has never in their history sold their delinquent loans on the market in the secondary space. Never. Until 2014. And they did it sort of as an experiment. Like, maybe we can get rid of some of these loans by putting them out there, and let's see if anybody buys it and see if it's a profitable venture for us. In 2016, one investment bank proceeded to win 30 of the offerings. Now, mind you, Fannie Mae has held 50 offerings. One investment bank won 30 of the offerings, paying upwards of 98.4 cents on the dollar for non-performing, delinquent, underwater loans. Let me say that again. They won 30 out of 50 of the offerings, and they paid upwards of 98.4 cents on the dollar for non-performing loans.
So somebody that's not paying on their mortgage.
Correct.
And they're willing to pay what we'll consider par, which is 100%.
Right.
For that loan. That's correct. Very interesting.
Who was that person? Who was that investment bank? None other than Goldman Sachs. Now, I won't get into this, but you can look up this particular article, and it goes into details of why Goldman Sachs actually got into buying delinquent loans. Basically, Goldman Sachs was involved in a lot of fraud during the housing bubble, right? Mm-hmm. Everybody kind of knows that no one got a slap on the wrist. Well, Goldman Sachs got a $5 billion penalty, right, lauded against them. And the loophole that our illustrious government gave them was to give them sort of an incentive that they could, basically they said, you got to pay us $5 billion, but you got to give the Justice Department like $3 billion of it. You got to give over here like another $1 billion. And then like the rest of it, that's what you're going to do to like do right by consumers. However, if you purchase some of the delinquent loans that you helped to create into the market, we will give you a credit on that $1 billion that you owe these people that you scammed. So at that point, you're incentivizing Goldman to say, we're going to buy these notes, make profits, and it's a credit towards a debt that we owe anyway. So you're actually paying Goldman at that point to do business. And so Goldman decided, we're going to turn up the temperature. We're just going to buy these, and they didn't care what they bought them for because they were really, being able to double dip. Okay. everything rolls downhill. The moment that you have investments, hedge funds, banks, whatever, buying for 70, 80, and 90 cents on the dollar for non-performing, you as a retail buyer are going to feel the effects. So essentially, 2014, you have Fannie Mae who says, we're going to try this selling the mortgage stuff, our delinquent stuff. By 2016, Goldman Sachs enters the race. By the way, Goldman Sachs, previous to 2016 and their settlement, Goldman Sachs was helping Fannie Mae to sell these loans. So they already knew what the loans were going for because they facilitated the sales. Then when they got slapped with the lawsuit, they then became a buyer. And by 2020, non-performing loans are selling for anywhere for 60 to 70 cents on the dollar. Okay. Everything has a trickle-down effect, at least for us, because we're retail. We're not at the top of the ticket. We're downstream. Okay. So the market was blue. If you look at this and you see non-performing loans go for 60 cents, 70 cents on the dollar, that's no longer the most profitable model. Okay. The market before COVID hit was blue. This is some information. Again, like this is where me and Justin's stuff kind of comes and coincides. The delinquency change, right, in mortgages. And I think I have a slide that'll illustrate this too. But the lowest level on record of delinquency. So the height of the housing crash got up to, I think it was 12%. I'll look at the chart again. I want to say it was 12% delinquency. And this is over almost every single mortgage in the United States. 12% default. Some of you guys who have portfolios of notes wish you had a 12% default. Some of you guys got like 30 and 40%. I'm sorry. I don't want to put your business out there, but it's true. So they only had 12%, but because they're over leveraged, it caused a problem. This is also in March of 2020. The non-current rate, meaning the number of loans total from 30 days past due or all the way up to foreclosure, fell below 2 million for the first time since 2005. So this is the market before COVID hit. This is March. This is what we were looking at. And I think I have a third thing. Here we go. You've seen this chart already with Justin. But you see the height where that peak comes in. That's about 10 point something percent delinquency. And that's around 2010. And then right down all the way to the right where you say it says 3.22. That's the market before COVID hit. And people are trying to sell you non-performing loans.
Right.
It not only fell from the delinquency rate, which is the average, that kind of like light green of 4.74%. It's literally the lowest on record. So you have the lowest amount of delinquency on record and somebody telling you this is a great time to buy non-performing loans.
Right.
Prove to me that it's the same market. It's not the same market. But again, not to shade anyone, some people can't pivot. Once they go down a trail and a path, they can't sort of maneuver their way around a new market. All right. So they'll just keep telling you the same thing. I actually heard from someone, and I won't name who said this, but questions started coming up of like, well, where's the non-performing inventory? Where's this second wave of inventory that's supposed to be coming? And this was probably August of 2018 that this question was asked. And this person who claims that they're, an expert in notes said, oh, well, it's going to come with the HAMP loans. Those HAMP modifications are terrible and people are going to default on them. And that'll be our new second wave of loans coming in. I just want to tell you right now, because many people might not know this, there is not one loan servicer who will touch a regular retail note investor who is even licensed to touch a HAMP loan. Meaning, we have maybe 5 or 6 servicers in our little space, our industry, who work with retail note investors. None of them are licensed to modify or touch a HAMP loan.
Yeah,
okay?
maybe one. There's maybe one.
I actually doubt it because I have inside information. Doubt
Okay.
it, right?
I just say that because I thought I'd seen one before from a servicer that we helped buy a loan.
Let me say this because we're being recorded. To my knowledge, there is no legally licensed servicing company who can legally touch a HAMP loan. That's what I'm saying. Not that they won't. I'm just saying legally they cannot.
Gotcha.
because you have to go through a special licensing process
Yeah.
in order to modify a government-backed modification program. And you have to jump through a bunch of hoops to do it. Our servicers who touch note investors, small retail people, don't want to jump through those hoops because it's not worth the cost most of the time.
Yeah, it probably takes a year to go through just to get your certification.
A lot of money too, a lot of bonding and everything too, right? And you're going to do that for an investor who may or may not even get a HAMP loan. It's not worth it.
And how many of them are there out there to buy too?
Right. And the thing about the HAMP modifications is those haven't blown up like people thought anyway. So even if they did, you can't get your hands on them. But in addition to them not blowing up like crazy, it just hasn't happened, right? But they're not going to tell you that because you when you're new, you don't have enough information to say, well, that's actually not true, Mr. Guru, right? They're kind of like playing on your ignorance to that. So that's just my little soapbox I'm going to get off. Lowest on record, okay? Lowest on record, literally. These are people who monitor mortgages. And this is the lowest they've ever seen on record. So you can see where the two lines kind of coincide. That's actually 2016, right? So even the chart is showing you, 2016, it got back to normal. All right. So where were the opportunities? Where were the opportunities that I missed because I did not see that market shift? I didn't know the market shifted from red to blue. And obviously, I need to kind of know what I missed.
Yeah.
So if I told you that there was an institution that you could call or you could contact, I should say, and you can ask them for access to all of the loans that they made in 2019, would that be something that you'd like to do? I'll give you the number of the person you could say, hey, I want to look at all the loans you've ever created. And it's a legitimate number. And you say, hey, I want to look at your stuff in 2019. And then not only that, I want to cherry pick what I want out of that whole list. Like, so show me thousands of loans, but I still want to cherry pick. Do you think that they would give you that information? Unlikely, just to put it lightly. I'm like, what the heck are you talking about? You're not going to look at all our loans and then cherry pick and waste are you serious?
Right.
But there actually is sort of an institution, if you think about it this way. There is an institution who will give you access to literally every loan they made in 2019, and you can cherry pick them if you like. That is seller financing. Seller financing in 2019 made 86,155 originations, which would put them at number 13 of the top 25 lenders of 2019. And you as a note investor literally have access to all 86,155 of those loans. And you can cherry pick. So this is just another way that I think of things. It's like seller financing is pretty serious if you think about it as a whole unit and not just individual mom and pops. It's an entire industry that no one is tapping into. If you ask the number one list vendor who's buying from you on a consistent basis, right? Because he sells lists to everyone, right? Because he's in the business of doing that. But who comes to you time after time after time because they're actually doing the business of brokering and buying these loans? He would tell you that it's less than 50 people in the whole United States. And he's conservative. If you ask the number one buyer, you ask them two questions. I'm asking two questions. The number one buyer is, I forget their name. It's FNAC. So
First National Acceptance.
First National Acceptance. That's right. First National Acceptance. The first question is, how many loans per year do you buy? There's 86,000 that were made in 1 year. How many do you think you'll buy out of that 86? They will tell you, we're going to average about 1,000. 1,000. 86,000 are made. 1,000 they're going to buy. The second question you ask them is, how many brokers come to you on a consistent basis that you do business with, month to month to month to month? How many serious brokers, not the one-offs and the people kicking the tires, how many serious brokers do you think there are in the note industry? Mind you, One person's just selling the list. The other person is actually buying. FNAC will tell you about 35. So you have 35 people in a nation of 300 plus million people who broker loans from the number 13 institution creating loans.
That's
And
incredible.
you're worried about where can I find notes? You literally have access to tens of thousands of loans at any given time by buying a list. So that's the first opportunity that you missed. Here's another one. This is coming from some research that I do, because as a note investor, I look in other places. I always look in other industries to figure out what they've figured out that I don't want to figure out, and I don't reinvent the wheel. There's a report from the Urban Land Institute that basically says, oh, well, not that part. The Urban Land Institute, it's not on this slide, is a research center, and they said that they follow basically like migration patterns of where people are moving in order to kind of give them an idea of where they should be investing. Note investors don't do that. We just think like, oh yeah, I'm just going to do some investment here. That's another way of looking at, okay, where are people moving to? A lot of people are exiting California, right? Where are they moving to? They're moving to Texas and Florida and places like that. So where's the opportunity for housing is going to be in Texas and Florida and places like that. We don't think that way, but that's how you kind of think a little bit bigger than just a regular note investor, right? The second thing the Urban Land Institute said was whoever, now mind you, urban land is mostly for rentals, and it's not just everyday landlords. These are like big wigs. They have like $4 billion portfolios and stuff, and like commercial real estate and things like that. So they pay people a lot of money to do this research, and they give it to you for free. They said that in the next 10 to 15 years, whoever can capture the affordable housing market will win. Whoever can make buying or living in a house affordable will win. You as a note investor have the power of finance. Everybody on this call knows it's easier or it's cheaper to own than it is to rent. You as a note investor actually have the power to give that to someone. You can finance someone into a house and make it affordable for them, right? One house might rent for $1,500, but the mortgage on it might be $900 or less, right? We have that power, but we have not really tapped into or enough into seller financing and really looking at real estate in that way. And as Justin pointed out earlier, real estate prices are going up. So the opportunity for some people like millennials, especially, millennials are in their mid-30s now. Many of them don't own a home because they have so much student debt. Their debt to income ratio is jacked up to buy a $250,000 house. They can't. You, on the other hand, have the opportunity to finance them into a cheaper house and get them started with something that they wouldn't have another opportunity to do. So I just want to run over, and I didn't put some other information in here, but we've got 1.5 million vacant homes. That was as of Q3 in 2019. Now, wow. We all know some of those vacant houses are, zombie houses. Some of you guys are also real estate investors, right? I'm a purist. I'm a note investor. I don't swing hammers. So I'm handicapped in that area. I see a zombie house. Some of y'all see money, and I see spiders. So I'm just like,
zombies.
I like this.
Literally see zombies.
Yeah, I see zombies coming out. I'm just like, I need to get out of here. So that's because I've always been in the note space. I've been on the paper side. So I readily admit that Czarina Harris is not like a real estate guru. I'm not. I'm a note genius. Anyway, the average seller finance loan is $198,000. I was actually surprised at that number. I thought it would be less.
I am too.
The average seller finance loan is $198,000. So that tells you kind of where opportunities are in that way. The rent for a 1-bedroom apartment average is $1,100. Okay. Or the average rent for a 1-bedroom apartment is $1,140. The mortgage on $198,000 is $1,187. So you're looking at $47 more to own on a $200,000 house versus a 1-bedroom apartment average. So that's an opportunity for you to say, oh my gosh, yeah, there's some houses I can convert from rentals into home ownership, or I can, find some, fix them up, finance them. Remember, guys, that because you're the lender and sort of everything revolves around sales prices, right? When you get a comp or you get a BPO, all they look for is comps, listings and comps. It's actually pretty simplistic, and I think it's antiquated, but because it's antiquated, it actually gives you an opportunity to manipulate any market you want to.
Yep.
What do you mean, Czarina? What do you mean I can manipulate it? Any market is 3 houses deep, meaning if this particular neighborhood, the houses sell for $70,000 a piece, landlords are going to be like, yeah, that's great for rent because I could charge a crap ton of rent and I don't have to buy the house for a lot of money. A note investor will say, you know what? I really don't like that $70,000 price. I think this is a $100,000 house. Do you know how many houses you need to sell or finance to turn that into a $100,000 neighborhood? 3. You need to find 3 people that you can sell or finance, because the real estate agents don't care who the lender is. They don't care if it's Chase, Wells Fargo, or you. All they care is what's the sales price. What's the sales price? And you can turn a $70,000 neighborhood into a $100,000 neighborhood by finding 3 people who will accept whatever terms you need, but you need a sales price. That is another opportunity that has been and is still very much now, especially on the table for us as note investors to do. That's what a blue market is. So instead of chasing 70 cents on the dollar non-performing loans, you could literally be creating money out of nothing. Soapbox done. All right. Hasn't COVID turned the market red? So this is just like a little rebuttal. I say it's not going to be 2008. Justin went over some of this stuff. If you look at 2010, which is actually the peak of the financial crisis, that was a 10% default. If you look at COVID, it went up to 6.91, so it didn't quite hit that way. And basically, this was open and shut in 2 months. So from March to May was the entire, well, not the entire, but majority of the people who put in for forbearance. And as of right now, I think I updated this. Okay, so the amount of loans in forbearance is declining. So I made this in in September, this whole presentation. So this slide, this little bit that you're looking at, I said I estimate that 2 million delinquent loans are going to be around by 2021. Okay, in 2010, that was 10 million delinquent loans. As of September month end, this was at the beginning, so I didn't have this data. But we're at 3.54 million people are in, forbearance still. And I think the total it's 2.3 million homeowners now who are in some sort of delinquency. So I estimated that by 2021, which is January, that we would be down to 2 million. And we're down to 2.3 million, and it's November. So that tells you how quickly this market went up and it's coming down. It's not enough time to say that, this is going to be a red market. It might be a red blip.
Yeah.
But again, it's not a red blip if you can't get your hands on that, because there's so many moratoriums and foreclosures aren't happening.
Yeah.
You can't call it a red market if it's done in 6 months. And at this rate, it's going to be hard to call it a red blip. It's November and we're down to 2 million seriously delinquent loans from 6 million in March to May. You just have to follow the data. Look at the prepayment rate, by the way. These are people who pay early. Mm-hmm. It's gone up 12% because people are nervous about what's going to happen next, and they want to stay in their homes because they understand that that's stability during crazy times. They're paying ahead. When were they paying ahead before? In March, when we had a 3-point-something% delinquency rate. Mm-hmm. So this is, quote unquote, as far as real estate mortgages are concerned, we are getting closer to normalcy than other markets. back to normal than other markets. This is something else I wanted to point out, just in case I didn't put a nail in this coffin enough. I want you to look at the 30-year rates that we were looking at from when the first crisis happened to what we're looking at now. If you were in 2000 to 2004, you're looking at a pretty high interest rate compared to where we are now. And keep in mind, a lot of these were adjustable, right? So that was part of the problem, was you got a 5.94 in 2003, and then by 2005, 2006, it went up to like 8%, right? Because you had an adjustable rate. That caused all these delinquencies, right? So when you as a non-performing note investor went in and said, hey, I'm going to give you a modification, what was one of the things you did? You lowered their interest rate, right? To bring their payments down and stuff like that. Well, what do you do if you buy a non-performing note and the interest rate is already 3.5%? Where do you go? You gonna give them a 0? That doesn't make any sense for you.
Right.
So even the mechanism that you used before, the way that you invested in non-performing before, has dramatically changed because it's not the same circumstances. You can't just reduce somebody's 8%, 9% interest rate down, like you did before, because it's not at 8 and 9, it's at 3 and 4. So the way you do business has also changed, just in case you thought, oh yeah, I'm gonna get these loans and I'm gonna just modify these things. That's the third nail in that coffin. So let's review. Pre-COVID capital is still in the market. This was some slides that I did not have before. Apologies. Seller's market, I think that's pretty obvious. Performing loans are still preferred, especially among investors, because people are looking for stability right now.
Yep.
The moratoriums are making foreclosures difficult. And I don't know that it's going to be all that important in another 3 months, because you're going to get a lot of these mortgages out of forbearance. Access to 500,000 plus seller finance loans over the past, I just did a 5-year window or 6-year window from 2014 until now. We have literally over 500,000 seller finance loans that is really not being tapped into. If you ask FNAC in the past 6 years, how many loans have you purchased? It's going to be less than, that number is going to be less than 8 or 9,000. So 500,000 loans, the number one note buyer bought 8 to 9,000. All right. As far as red, there's now 2 million. So I have to update this. It's not 4 million people in forbearance. It's 2.3. There is still a delayed eviction crisis going on. So that is putting a lot of pressure on landlords, which I have my opinions about why in the world the government would extend a moratorium and not write landlords a check. So I'm not going to go there tonight. And new delinquencies are resulting from natural disasters. So that is something that always happens, is it gets very localized. Those hurricanes that happened in Texas a couple years ago that caused all that flooding, there was an increase in non-performing there. I'm pretty sure the hurricane that just ran through Louisiana is going to cause more delinquencies. But again, now you're talking regional. You're not talking national. Okay. So where do we go from here? I'm going to stop here because I saw some chat stuff coming in and like some questions.
I've been fielding the Q&A
okay.
behind the scenes for you.
Okay. Appreciate it. Thank you. You're a good
welcome.
assistant.
Got team
good
up.
Co-host.
Power team.
Yeah. All right. So I promised everybody that I would reveal a little bit about what Note Inc. is doing behind the scenes. Just for full disclosure, I never really talk about what I'm doing, which is why you have a crazy person coming out with a fictional podcast. Because, credit. We're talking about credit, right? Lisa Hokinson doesn't know this. And now she's here and I can actually say it where she can hear it. When somebody tells you something and they tell you, you heard it 50 times, and it's the 51st time that you actually understand it, or something like triggers and like in your brain. That's what happened when I called Lisa Hokinson like 4 years ago, something like that. And I said, hey, Lisa, I'm kind of sort of thinking about doing a podcast, but I'm really nervous and I don't know if I should do it. And, there's a lot of them out there anyways and whatever. And at one point in the conversation, she said, Czarina, just do the podcast, do your best. And if it doesn't do well, at least you know you tried. And something in, like, I'd heard that from people all my life, right? Just do your best and it's fine. But something in that particular conversation triggered in me to say, you know what? She's right. And I should do this podcast as if it's the last podcast I'm ever going to make. And therefore, I'm going to make it my way, because I grew up on, my favorite movie as a child was A Christmas Story. And you know, Ralphie's in front of the radio listening to Little Orphan Annie. So I was like, I really like that sort of fictional, you know, theater of mind type of thing. And that actually is why Note Inc. is a spy-themed fictional podcast, is because of Lisa Hokinson. So if y'all could put something in there for her and say, thank you for inspiring Czarina, I would appreciate it, and give her her flowers. So I keep a lot of stuff behind the scenes because people love to copy me, and it's easier to copy somebody than to actually think for yourself. But I'm going to tell you one of these epiphanies that I've had, and I don't know if this because I'm a smart cookie, or if it's because I think a little bit differently, or if it's because I've been around the industry for a while. I really can't tell you how I came up with this epiphany, but I'm glad I did. And what I did was I essentially, and I don't have all the slides, so I got to explain this a little bit. I reverse engineered what it would take a note investor to build a business that did 1 million in revenue a year. And I just looked at it objectively, like, what would that take? And I kind of summed that up in, well, if they did 100 deals and they averaged $10,000 per deal, that gets them to 1 million. Now, it's simple, but it's not easy, right? So something can be simple, but not easy. And what I did from there, I said, okay, well, how do you do 100 deals? And how do you make sure that they're all 10,000 or above? And you just keep thinking, and you keep thinking, and you keep thinking. And what resulted from me doing that, it took me like maybe a month, but I reverse engineered it. And then I said, oh, there's a whole sort of like machine and a whole process that you need. And so I call this like the machine. This is kind of what Note Inc. is up to. So be glad you're on this webinar tonight, or else you would not know. So to preface this, I say that note investors kind of go through a process and sort of an evolution of sorts. When you first learn about notes, you get really excited. And you're like, oh my gosh, I just need to learn about this stuff. I want to learn this, and then I'm going to have a note business. Like, I'm going to learn from XYZ person or this guru or buy this information or whatever, right? And that's sort of the first step that everybody comes to. Nothing wrong with it. And I'm not downing it. I'm just saying that's the first step. It's like, I need to learn this. Then I'll have a note business. Then you say, you know what? I know enough. I just need to close a deal. And when I close a deal, then I'll have a note business. And people start closing deals. The cool thing about the note industry is, like, our deals, our transaction size is usually higher than everybody else's. So when you close a deal, you know, you might make $20,000 on that one deal or whatever, you know, like, that's how our industry is. It's really cool. And it's very exciting when you close your first deal and actually make a profit, because all the naysayers in your life are like, so what? You know what I mean? Like, you could really bring that back to them. But then you maybe think like, I need to do more deals, right? Or I just need to find more sellers so I can have more tapes and get more deals on my desk, right? And sort of this is where you keep sort of growing. Like, yeah, I did one deal, I want to do another, but I need to find more sellers. I need to find more resources. I need to network more and find people who have deals who can send them to me, right? Okay, cool. Then you get to the point where you say, I just need to learn like another aspect. Like, maybe I can like start looking into seconds, or maybe I can start doing like, if you were non-performing, you maybe think like, oh, maybe I'll just learn a little performing, or maybe I'll start doing partials, or whatever the case might be. Now, what you don't realize when you do that, though, is you've circled right back to the beginning. I just need an education. First, you got an education, maybe in non-performing. Then you did a deal, and you maybe did some more deals, but now you're feeling like something's missing. And now you're like, I just need to get an education in seconds, or I just need to get education in XYZ. And you're repeating the same pattern over and over and over and over again. Now, the good news is, like, at least you're making money, or you should be. But the problem is you're stuck in a loop, and you're just stuck in a loop. So you go to another conference, and you go to another webinar like mine. But I'm just telling you right now, I understand what I'm part of like a monster machine. But you do these things because you know, as a note investor and as an entrepreneur, something is missing from my business and I just need that nugget that's going to throw me over. I don't know what that nugget is, so I'm going to keep looking for it. But something's there. One thing entrepreneurs understand is like, my business is not where I want it to be. Okay? If you're one of these people who is like, I have a note business, but it's definitely not where I thought I would be, put like, I don't know, just type 1 in the chat or something so people can see like, oh, I'm not alone. My business is not where I wanted it to be either. All right. So I understood that. So I said, oh, there's a whole machine. So I'm going to take you guys inside this machine. I don't really reveal this kind of information because people copy me. But this is the machine. So you have this. This is what I call the machine. And as you can see, as I'm animating this, there's a lot of parts to this thing. And you're like, what the heck are these parts? So we're going to go over what they are, okay? First one is education. Notes 101, maybe a strategy too. Most of you here are doing that. You're actively part of like getting yourself an education. So you definitely need that. So I'm not downing it at all whatsoever. You do need an education in notes. But there's more to the machine, right? The next thing is you actually need lead generation. And in this case, I'm just going to use the example of seller finance. The reason I'm using that example is because you can literally get your hands on it whenever you want. You're not passive. The way that many of us, and even me, were taught the business is almost a very passive way of getting deals. Go out, network, and have people send them to you. Well, that's fine and dandy. And you know, you can still close them. It's not like the deals morph themselves into like whatever, but it's passive. I can't tell you, okay, go out right now and go find 100 non-performing note deals by tomorrow.
Right.
Like, I don't even know where the heck to get this. What are you talking about? Okay, go out right now and find 150 performing notes for sale. Can't do it, right? That's what's missing in a lot of our businesses. So moving on, private capital. Many of you guys have this. Many of you guys have, you know, private capital, or you have enough capital in your own business to buy some things or whatever. So I won't get that ad nauseum. Number 4, education on closing and due diligence. So many of you are good at like the due diligence part of a deal. Many of you guys are good at like finding the deal, but then you get down into the weeds and you realize, oh my gosh, there's so much more stuff than just actually doing the deal that I need to close. But you learn it because you can't avoid the closing process if you're doing deals. So you learn that stuff. Okay, cool. Number 5 is automation. I don't know anybody who has an automated business. Mm-hmm. Justin is probably the closest. Right? Number 6 is you need an investor relations director. How many of you guys have employees in your business? And number 7 is you need a closing specialist. How many of you guys have 2 employees in your business? So I'm telling you, I'm going to reveal to you right now, the reason why you keep having this, like, man, there's a nugget I'm missing, there's something I'm missing, is because when you look at this inside of this machine, and I could, you know, I would love anybody to debate, like there's more to it or something like that. I don't think so, but like, okay, you're literally operating with 3 out of 7 pieces, and you're wondering like, what's missing?
Right.
If you think about it that way, you have a lot missing. You just don't know what was missing. So if you're writing this down, hurry up because I'm going to switch slides.
Or recording this so they can replay.
Okay, yeah, that's true. There you go. So I can move on. But this is literally the machine. This is what you would need, by the way, to operate a $1 million in revenue business, because you cannot, as a single person, handle 100 note deals a year by yourself. And when I talk about strategy, and then I'll move on, a lot of us naturally, and I think this is probably what you should do in the beginning anyway. A lot of us, when we come into the note space, we do deals for ourselves. We buy for our own portfolio. We do deals because maybe we're trying to get out of another part of real estate and we want notes to kind of take that over for us, whatever the case might be. The end of the thing is you do deals for yourself, and you might start getting like passive investors to fund deals you do for yourself. The moment you switch your entire strategy into what I call like the Edward Jones model. Edward Jones, Charles Schwab, TD Waterhouse, what's another one? Fisher Investments.
Yep.
The thing that all of these companies have in common is at some point in time, the owner or the entrepreneur who started that company decided that they were going to help other people invest. And the moment that you decide your note business is going to be centered on helping other people invest in notes, that's when it's a game changer, because other people will always have more money than you, right? They will always have more money than you. And therefore, as long as you can keep supplying them with deals, you will continue to make profits. And so I said, you know what? If you're selling a note to a passive investor, or you're selling a note to somebody else, it's really not that hard to make 10 grand on that, on a performing note deal. And if you could do 100 of those a year, yeah, that's $1 million in revenue. So that's the strategy. You have to sell notes to other people. You'll never make $1 million in revenue by yourself. And these are the pieces that you're missing.
Yep. That's very well laid out.
Appreciate it. You see how people steal my stuff? You know how long it took me to figure it
I take credit for that.
So this is my little, I think this is one of my last slides, second to last. I say that many investors are working very hard, because they are, but on the wrong strategy. And that's why they can't pivot.
Yep.
If you're one of these people who are like, I know there's a nugget out there. I know there's something out there I'm missing. It's true. You're missing 4 pieces. Okay, 4 nuggets. And if you're also one of these people who's like, crap, I did not see that shift. I did not see that back in 2016, non-performing wasn't it. And maybe you're like, I wasn't even around. I just came in 2018, or whatever the case might be. That's fine, because we all have a place where we start to learn from. As of right now, you are listening to Czarina Harris, and I say it's not there, okay? It's blue. And because it's blue, what are you going to do? You have to start thinking of your business as a business and not what I call a lucrative hobby. Mm-hmm. Many people are operating a very lucrative hobby and not a business. You have no employees, you have no payroll, nobody helps you. Maybe your business partner does, but that's it. And you're not where you want to be. And there's a very good reason for it. So that's my end of my soapbox. A couple of people asked, like, how can I figure this out? And so I put it together in a course that I call Pathfinder. Literally, this is the only thing you can buy from Note Inc. right now, because I keep everything close to the chest in terms of what I'm doing. The reason this is the only thing you can get from me is because I have a beta group that you cannot join right now. And we are working on building out literally every single piece of that machine. So right now we're in lead generation. And once we have that down, me and my chickadees will be the only people who have a lead generation machine in our business. And we're just going to keep moving forward. So the Pathfinder really is to get you out of the weeds and get you into the right strategies. And what I did was I put together 7 strategies, period, in the whole note business that even make sense. So you don't get caught up in doing other things, even if your guru says so. And you say, this won't make me money. All 7 strategies are literally the strategies that make you money. Everything else is noise. And I put that together, and I also put together an evaluation to figure out where your business is, what your business actually already has, what you've done right, and what you're missing, so that you can kind of move forward and say, you know what, I'm missing this, and I'm missing this. And that's just kind of how we operate here in the Note Inc. world. And here's some wonderful testimonials.
Absolutely. Somebody else chimed in as a testimonial too. Keith did.
Oh, yeah? Okay. Very cool. I appreciate some of my peoples is here.
They representing.
But what I did is you can find it at noteinc.com/Pathfinder. Everybody who gets it, you'll get the full market shift report. Again, it's like an hour and a half, hour and 45 minutes. I've touched on a lot of it here, but again, we're time limit. So that's everything, Justin. You want back the screen?
Yeah, thank you so much. That was a very well done presentation. I'm glad you got a chance to do that at the conference you were at. What was the name of the conference again?
Yeah, it was called the Wise Women Expo. It was pretty cool.
The Wise Women Expo. Well, you were definitely wise, and I'm glad you were there. All right. So the last slide I have for today is just to let people know about the next meetup that we have. We have once a month. I think it ends up being on the second Wednesday of every month, 6 to 8 p.m. Eastern. Follow me on social media at Bright Path Notes on any of the Facebook, Twitter, Instagram. I'm on LinkedIn as well. Connect with me if you want. Here's my email at the end again. Czarina, if you guys don't know Czarina, her email, go to info@noteinc.com. It's noteinc.com. And that website again was noteinc.com, noteinc.com/Pathfinder. And so you can get to that access. I had my chat window disappeared. Let me go find it again.
Uh-oh.
And
you got a really cool audience. Thank you guys so much
Selena.
for being here tonight.
Yeah, absolutely. You guys, it's a great audience. We have always great banter back and forth. So now is the time to ask questions if you want.
Questions.
I am going to stop the recording because we like to do this so we can have more fun afterwards. Cool. So we're going to stop the recording. So those of you that are watching the recording, thank you so much for watching. And reach out to either Czarina or myself if you have any questions or need help with anything. We'd be glad to help you. And we will see you next time. And the rest of you just stay on.